One of the main priorities for you and your limited company should be working out the most efficient way to draw down income from your company. This video will guide you through what your optimum salary is in the 2020 to 2021 tax year. Having flexibility over when and how much you're going to pay yourself is one of the advantages of being a limited company director. Most limited company owners take income in the form of dividends and a small salary. Taking dividends has a huge benefit as you do not pay any national insurance contributions, whereas on a salary you do. As a result of this, an average limited company owner might save a lot of money each year. Here are two options to choose from when working out your optimum salary level, and possibly that of your spouse if applicable. For most limited company directors, the most tax-efficient salary in 2021 is £9,500. If you are entitled to the full personal allowance and your salary doesn't cross the threshold, you will not pay any income tax. You will also only start to pay employees' national insurance if your salary reaches the £9,500, meaning that this is the most tax-efficient salary to draw. You will pay a small amount of employers' national insurance of £98, but this is less than the corporation tax saved, so it is still beneficial. There are no legal requirements to pay yourself the national minimum wage unless you have a contract of employment with your own company that states otherwise, although this is very uncommon. This salary is also above the lower earnings limit for national insurance required in order to qualify for the state benefits. You need to make sure that you include any other possible income you have already received in the year. For some directors, a tax-efficient way to pay yourself more than £9,500 is to claim the employment allowance. This is only applicable if you are not the sole director or employee of your company earning over the secondary threshold, i.e. you must have another employee and you are not already claiming the full employment allowance. First introduced in April 2014, the employment allowance will refund any employer's NICs your company pays. There is an annual limit on this allowance, so you will need to check it is not already being used on the NI for the other staff. Therefore, this salary usually works for businesses with 1 or 2 staff. If this is the case, you can pay yourself up to £12,500, which is the tax-free allowance. Paying yourself this amount during the current tax year means that you will pay no income tax at all. The salary is deducted against your company's corporation tax bill. You will pay £360 in employees' national insurance on the extra £3,000 of salary, but will save £570 in corporation tax. Overall, you'll be around £210 better off per year as a result of corporate and personal tax savings, meaning you are better off paying yourself £12,500 salary if you are eligible for the employment allowance and you are not using it on the other staff. You want to earn more than this minimum salary, and hopefully your company has more cash it can pay you. You will take this as a dividend. A dividend is a sum of money that is paid by a company to its shareholders out of its profits or reserves. There is now also a dividend allowance, which allows you to take the first £2,000 of dividend tax-free each year. So the optimum way to take cash out of your business is to take a salary of £9,500 and then take the rest as dividends. If you're not the sole director or employee, you may be able to take a salary of £12,500 by claiming employer's allowance and then the rest as dividends again. I hope you found this useful. If you would like any more tips, please subscribe to our YouTube channel.